The broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, ladies and gentlemen. Lovely to have your company with us this evening. Good morning to our friends in Queensland. Good afternoon to the others in Australia and also in New Zealand. Nice to have all of you. How's the sound, folks? Somebody please just type in the questions box and tell me that you can hear me all right. Yes, says Mark. Oh, there's Mark. Hello, Mark. There's a guy, tutorial guy. He's going to be a very, very good trader, Mark. Thank you. He's got sound, so have others, so that's all good. Okay, good. Oh, Mick Dougal's with us. Hello, Mick. You're out there in the west of Ipswich anyway. Ed's doing a tutorial. Dean's a tutorial guy. Dean's a bit of a star. Dean's paper traded about 20 markets for the last 3 or 4 years. He's doing a time trading tutorial. Dean did an early tutorial with me, maybe I'm going to say maybe 1990. No, not that long ago. Maybe that's a decade out. 2010, perhaps, in Colorado Springs. Either 2010, 2011, something like that. Mike, nice to have you with us. Mike Olenek, he's a tutorial guy. Oh, they all are. He didn't really get a huge amount out of it, but he came back recently, and he's in the process of finishing off a time trading tutorial. Part of that is I like you to do some paper trading to answer your own questions, and to really, because it's so intellectually different, you need to really seal it into your mind as your default trading approach. Dean's an absolute marvel. He's just churned out spreadsheet after spreadsheet after spreadsheet. He sent me an email a couple of days ago showing about 20 markets for the last 4 years. Absolutely fantastic. Great work, Dean. Big effort. Well done. Okay, let's see who else is here that we've got to say hello to. Nice to have them. Alan, he's a tutorial guy. So is the other Alan. There's 2 of them, both doing tutorials. Chase, who's always at me to give up cigarettes. Chase, I'm starting to try to do that. Daryl in Mossman, nice to have you with it. David up in New York. David's a wealth fund manager. Webby, the king of the black lines. Ed's a tutorial guy over on the west coast of the US. Jerry's with us. Jerry Winter, our broker. We haven't seen you for a long time. Jerry, great to have you with us. John Chiwa. Thanks, Chase. Well, John Listerman, I missed you, John. We were going to get together when you were up here over Christmas, and I got the dates confused. It was a bit busy time. Anyway, I hope you had a safe trip home and enjoyed your holiday up in the sun here, mate. Justin Woolley's a tutorial guy. It's him and his dad down around Singleton. Kevin, Happy New Year to you, mate, and to Mark as well. All of you, thank you very much for being with us. Marvino, good to have you with us again, Marvino. Greetings from SoCal, says Marvino. Great. Marilyn, the lovely Marilyn. Always important to say particular hello to the ladies because we don't have many of them. Michael Peel, I don't know where you are, Mike. You move around a lot, but great to have you with us anyway. Okay, so all the people, if I haven't said hello to you, Raj, hello. Rob H, he's my mate from New Zealand. He's a really insightful analyst. Tom down in, we've got both you and your partner with us. We're indeed blessed. Tom Risky, he's a builder up in near Vale. Tom's going to do a tutorial soon. Maybe you can start next week if you like, Tom. I've got some vacancies. Vicky, particularly nice to have another lady with us. Vicky's a long-time member of the Daniel Code, and Bill Ford as well. Thank you all. Okay, let's have a look at all of this, folks. It's going to get round to my favourite subject. Some of this you're going to find, those of you who've been trading a while, you're going to find it a bit banal, but I remember the days that I was starting to trade and trying to make sense out of it all. And it is really quite incredible how random charts appear until you actually understand what makes markets move. And once you understand that, just how beautiful they are. It's quite incredible. Talking about targets, this is a big issue for a lot of people. Most trading programs encourage you to have a target and then get you involved in what percentage of the time was the target reached, etc. Mike, when am I coming to Chicago? I don't know. We're still waiting after 2 years for our automated trading program, which has been promised for next week. I have to say it's been promised for probably 40 other times in the last 2 years. As soon as I've got that, I'm going to be coming over to Chicago. I want to talk to Jerry and other people who might be interested in our automated trading program. I'll let you guys know. Don't worry about it. And we'll get together and make sure we have a couple of cold ones as well. Here we are. Oh, yes, John, thank you for reminding me, folks. It's Australia Day today, which is a big deal for some Australians. Not for me. I can't really give you a reason other than being aware of it. Some people get very excited about those things. My gardener said to me, well, I can't come on Friday, it's Australia Day. And I said, well, you know, the grass doesn't know that. Come on Friday anyway. But for those of you who are taking the day off for Australia Day, good luck to you. Have a few beers and enjoy. Be grateful to live in this wonderful country that I criticize. I criticize all sorts of things, but we're really blessed to live in one of the great countries in the world. Okay, when you start looking at targets for your trading, you're going to start probably with something mechanical. And there's two ways of doing that. You can take a percentage of the existing ranges. That's what this chart shows. This shows you a percentage of the pullback from the September 2017 highs in gold. And you can see the market's pretty much stopped at that level and rallied from it, and rallied twice from it, and then broke it. So the first thing to remember in all of this stuff is we do not have foreknowledge. Okay, we don't know what the market's going to do tomorrow. I don't know, and I can tell you if I don't know, it's certain you don't know either. And I have a lot of students say to me, oh, you know, I thought it would do this, I thought it would do that. The whole point of trading, once you know how to trade, is that you don't have to know what the market's doing tomorrow. If you've got a proper trading program, the information you get at the end of day data tells you every probability of what the market will do tomorrow, and you then construct your orders to cover those probabilities. And trading is really as simple as that. Now, having said it's as simple as that, I guess that I was involved in trading for at least 15 years before it began to become as simple as that, and that's when I started to find the Daniel code. But once you know the Daniel code, you will find that markets more often than not are reasonably predictable. So looking at how you construct your targets, excuse me, that's one way. The next chart, this is also COMEX Gold. This is showing you a fairly old-fashioned method of taking a range from A to B, then extending it down from C. The 62.5 on their number, that's a Daniel code number. If you're a fib guy and you still believe that the fornication rate of rabbits influences markets, you'd have used 61.8. Again, though, these dominant sort of major targets, they get reached again and again and again. The problem is you can't tell, unless you know trend very, very well, whether the market is going to get to that next target or not. This is another form of mechanical target, and this is simply a 100% range. And as you can see on gold today, it just broke through that target and then did a big key reversal bar. If that low is elected tomorrow, or today for you folks in America, remember I'm on Friday already, down under, we're a bit ahead of you in time, then you've got a potential false break sitting up there, and a false break can often give rise to fast moves. So stay right on your toes. We could be going to see some really fast moves in the US dollar index, and that's the inverse correlation to gold. Gold and silver generally moves the opposite way to the US dollar index. And if you don't understand currency values, particularly what currencies do on the cross rates, you're failing to understand a whole lot about your personal wealth and your business. And I'm going to come to that as we move along. Here's another oldie that you're often taught, those of you who are traditional traders. Old highs become new lows, or old highs become support. That idea is right often enough for them to show you examples. Here's one that takes a fairly big view of gold. This is starts from October the 16th to date. And you can see that a couple of the old highs, the minor high in very late January, or February, I should say, 17, and the other high right at the end of February, they both went on to become support much later in April 17 and in December 2017, and then multiple support through September, October, and November. But knowing their support is one thing, whether they'll hold or not is another thing, and that has to do with trend. So let's see where we are now. So those old-fashioned ideas of trading, I've found they're just valid enough to give them some credence, but they're not really accurate enough for the sort of trading that we do. This is another way of, another example of extending the range. Here we've simply taken the range from A to B and extended it from the first pullback C. It's rough and ready. Sometimes it's very, very good. In this case, it's not, but as merely as targets, this is not such a silly idea. When it's valid, and once you stop using those sorts of numbers and start using the Daniel code numbers, you'll see that what I put up here, when it's valid, you will see target recognition. Now, this is actually a retracement from the December 16 low all the way up to the July 16 high using the Daniel code numbers. Theoretically, that's resistance in the rally back up. But if you look at all of these arrows I put on, it's amazing how often the market, because the market knows the Daniel code numbers, they're not arbitrary and they're not fibs, because the markets know and understand the Daniel code numbers, look how often it's tested these numbers from the other side. It's quite extraordinary. All of those arrows show you where the market, and some of this is done historically, because those little counter trend lows around mid-2016, they were well and truly established by the time the low came in December 2016. But you can see how nonetheless those markets, this is on the close, this is what we call a close-only chart. Target recognition is valid at the bar high-low or at the close. And it's quite extraordinary how often the market's gone to test those numbers. And even though it doesn't actually give you brilliant resistance on the way up until you get to the ultimate high, the fact that the market goes down and tests these numbers from the other side is a phenomenon that you see often when you have valid numbers on your chart. If you've got valid support and resistance on your chart, you'll find that if the market runs through one number, it will normally come back and test that number from the other side. That may be a matter of days, weeks, or months, but that's the real test of validity. And as you can see here, this market has just gone back to retest those Daniel code retracements time and time again. Those sorts of fixed numbers don't have a great record. They're overly simplified, and it's not what we do for targets. For our targets at the Daniel code, we create two sets of numbers for you. We create the red and black lines, which are retracements of an operating range, and we create the blue lines, which are extensions of the operating range. This chart happens to be COMEX Gold, so let me bring that up and I can tell you more about that in detail. Here it is. What we have here is on Wednesday, we had the market, remember, target recognition is valid at bar high, low, or a close. On Wednesday, we had this market closing at 1357.8 against the blue line at 1356.6. and that's target recognition. 1356.6 to 1357.8 is 12 ticks. In a number like 1364, that's 13,640 ticks, we're going to allow 0.01% of our variance. So you get target recognition from Wednesday, and then today, as you can see, the market opened a bit lower, dashed up. There's another blue line there on the members charts. I haven't put it on this chart. These charts are not exactly the same as the members charts because the members charts are kept on another computer, and I don't actually copy them across. I just pick the key ones for you to see. But there are blue lines on the members chart at 1364.5. The high today, 1365.4. 9 ticks variance in a number that has potentially 13,000 ticks involved in it. So that's the sort of precision in the level of target recognition that you need if your numbers are valid. If you can create valid numbers, good luck to you. It probably took me 10 or 11 years to work out the Daniel code. Those of you who are members, which most of you are, and look at our members charts regularly, the normal comment is, wow, this is just so amazing why these charts keep going to these numbers. For you, Tom, and also for let me see, someone else here was, of course, David, up in New York, your mate, your partner, very interested in trading natural gas. I'm going to start adding natural gas charts. Not only for you, a lot of people trade natural gas. We've had a lot of requests for it. And the trading in natural gas has just been absolutely phenomenal. Hasn't it, Dean? Let me see if I can just bring Dean's... let's see if I can just bring Dean's last email to me up here. Here he is, and what he's going to tell me is, see if I can find what he said about natural gas. No, he's left natural gas off here, but I know you've been trading natural gas, Dean. But David was saying he hasn't been trading natural gas much, hasn't been getting great results. Natural gas has just been phenomenal. Anything related to the oil complex, we've had really good volatility and quite amazing results from trading recently, particularly if you're trading time. Okay, those of you who've done tutorials know what I'm talking about. Okay, so let's move on. So we ask ourselves the question, why are targets important? Because when targets are achieved, that's what causes turns. This is the next chart. This is actually the same chart you were just looking at. Yes, thanks, Dean. Didn't do natural gas on this go around. Did it last time. 2017 was great, as you say. Quite right. Let's have a look here. This is the same chart that I showed you just now. It's got the Daniel code blue lines on it. And now we've added the time cycles. Now these time cycles are valid for plus or minus 1 period. That's because time cycles can be started from either a bar high-low or a closing high-low, provided that those two types of bars are within a proximity of 1. So because they can start validly from one of two consecutive bars, that means the end result of the time cycles is also valid for plus or minus 1 bar. You can see moving through these, the first 44 cycle there, that's the cycle for gold. That's the particular cycle for gold. Gold reacts on all of the Daniel code cycles, of course. We got nothing from that. Then the next 59 cycle, we got nothing from that. The 62 cycle, let me just bring this up so I can give you dates so you can follow this yourself. The 62 cycle, this is gold, COMEX gold. On the outside bar, that outside bar that the 62 cycle is on is January the 4th, 2018, folks. That caused a little bit of a pullback. 1, 2, 3.5 bars down, rallied back up. Our next cycle came on the interim high, which was January the 15th. You can see the 70 cycle came the day after that. So that's a valid plus or minus one period. So that particular bar, January the 15th, had a 70 time cycle on it, the heathen cycle. We call it that because it comes from a different part of the book of Daniel. Of course, it's not a heathen cycle. It just comes from a different part of the book. But it's valid, particularly valid on anything related to the euro. We see it a lot, the 70 cycle. We see that a lot in the DAX, the CAC, and in the euro pairs. Okay, so we move on. Then we had our 59 cycle, gave us nothing, and our next 62 cycle is the one that terminated today. And you can see then for gold here you have what causes turns, time and price. Okay, either of them can cause a turn on their own, but the very best, the strongest turns come when you have time and price. What we say is when time and price are squared, a turn is almost inevitable. To find squaring, that doesn't mean the GAN stuff that they're on a 1 by 1 or a 3 by 1 line. It means simply that the market is at a recognized Daniel code number, as it was yesterday. It was sitting at yesterday's close, was 1357.8, and there's a blue line on the members chart. It's not on this chart. There was a blue line. You can see at 1356.6. That was target recognition. And then we had the 62 time cycle expiring today. So we've had time and price, means a turn is almost inevitable. Now, none of this stuff speaks to quantum. I want to make that clear. Whether we get a turn that starts a completely new trend, or we get a turn that's just a minor correction, that's something we see as we go along, and we have various tools for managing that and dealing with it. But these studies are blind as to quantum. Okay, as you can see how nice that turn has come in there. Let's move on. This is still the same chart. I put a couple of interesting red lines on here for those of you who are really interested in forecasting. One of those lines is a fifth seal line. The lower down of the two is a fifth seal line, and the upper one of the two is a fourth seal line. And they both start from a low before the low. And there are many lows before the low. There's a bit of a technique to finding which ones are likely to be valid. But they also, they're an angle. They're what we call the fourth degree, or the fourth seal, if you like. And I use seal there in the biblical sense of it being taken off and revealed. You can use fourth degree if you prefer. Both are valid. And they're the sorts of things you're dealing with in markets. Price is the first degree. Time is the second degree. Volume is the third degree. We don't use it much anymore because we don't get accurate feeds of volume with all of the off-market stuff, over-the-counter stuff, and other types of trading that go on, dark pools, etc. And the fourth degree is an angle, and these red lines here are angles, and as such they have features of time and of price. And you can see here that both the fifth seal and the fourth seal gave us today's high pretty much perfectly. Does it mean that's the high? No. These things are dumb as to quantum. They're simply, at that stage of the market, they are resistance. If this market turns around and charges down, we'll say, wow, wasn't that wonderful? But the reality is they're just support and resistance. Remember, we do not have foreknowledge. Okay? We know from what the end of day bar tells us what the probabilities are for tomorrow, and that's all we know. And the good news is that's all you ever need to know. We've switched over here to the DAX. This is Germany's S&P, if you like. Very good trading market. It's got a nice chart here for you. And let's have a look here what we've got. This is another example of time and price being squared. If we just run through this chart, if we look at the low, the first low on this chart, which is January the 2nd, you can see that came at a Daniel code blue line, 12,731.5. There is a mini DAX out now, folks, those of you who are interested in trading it. The big DAX is a very, very big margin, 20 odd thousand plus margin. There is a mini DAX out now. May still be too big for you, but it's an interesting market. I love it. So that particular low, the first low you see on this chart, the low of that bar was 12731.0. The blue line was at 12731.5, which is one tick. This market moved in half a point. And it came one day after the 44 cycle. So remember we said that, I'll just put a highlighter on here so you know what I'm talking about and you can follow this. Let's see where we get a highlighting tool from. Here we are. Spotlight, he calls it. Here it is. So it's this bar here we're talking about now. This is the bar of January the 2nd, 2018. Look where this bar ends. Okay, I've just got the spotlight on that. The low of that bar is 12,731 against the Daniel code number 12,731.5. 0.5 is one tick. Then we had a nice run up. We had a sell up here. Down it comes. Look what's happened today. Here's this number here. We've got, this was actually Wednesday's high. Here's Tuesday's high, I should say, forgive me. The close of Tuesday's high was 13,569 against the Daniel code blue line at 13,567. The close was 13,569. That's what you saw on the members charts. What you didn't see on the members charts, and it made no difference, is there was another blue line at 13,597.5, and the high of that bar finished up being 13,596. 3 ticks, that's 1.5 points, is 3 ticks away. Absolutely amazing stuff. And it came the day after the 59 cycle, which generally gives us tops. Okay, so the same way as the market turned a day after the 44 cycle, it put in its high a day after the 55 cycle. Today's low, look where it went to. There's a red line there at 13211, and the low today, 13214. 6 ticks away using the half. Quite incredible. If you use the Daniel code, you will find markets doing this all the time, all the time, all the time. And no, it's not a stuck record, but it's amazing how markets run to these Daniel code numbers. They do that because the Daniel code is built from the DNA of markets, or I should say the other way. Markets have the DNA of the Daniel code. That's how these bars are created. And we see this level of perfection or near perfection, close enough for government business, as they say, all the time. Right at that nice high there on Tuesday, we had all the sell signals for you. In fact, on Tuesday, we had, let me see when they came out. We had it before that. We actually, DAX. We had a, on the Tuesday, for Wednesday rather, for Wednesday posted Monday night when that bar finished, we had a TO3 sell and a blue line sell. So look how precise and orderly these things are. So how do turns happen? Turns happen because of price and time. And sometimes you get the two together. In fact, often you get the two together, but you can't see them as being together all the time. Now let's have a little look here. This is still the DAX. I wanted to show you the difference between simply trading price and trading time. So this chart here starts about 6th or 7th, bit earlier than that, of December last year. Let me see, I'll give you the right date. The first high you can see where it says time sell signal, the bar we're talking about there, that's December the 18th, 2017. You can see that we had price as well. We had a retracement at 13,320. The close or the high of that bar was 1331. Not too precise, but remember this is a very big number. So we certainly say we had target recognition there. We didn't get a price turn signal there because for the price trading, we're using other tools like stochastics and momentum indicators, and they didn't line up. But it was a time sell signal. Then we ran down into this low, which is January the 2nd. The low of that bar, 12,731.0. The Daniel code blue line, 12,731.5. One tick away. Perfect target recognition. That was a time buy and also a price turn signal. From there, it rallied up into this high here, which is January the 9th. I've taken off the price levels there. We had a price target there with Daniel code numbers. So that turn gave you a price turn signal and a time sell signal. Then we had a run down into the low. We had a time buy and a price turn signal. Back up into the high we've just been talking about, which was Wednesday's high, Tuesday's high, I should say. Perfect target recognition, stochastics overbought, huge loss of momentum, very easy to get price turn signal. So trading price, which is what most of you do, and it's a large part of what we do at the Daniel Code, will get you almost all of the important turns, or the vast majority, I should say, of important turns. The thing about this new discipline we're using now of trading time is that time signals get you every single turn. I hope, I've been teaching that to tutorial folks for the last 18 months. They're all terribly thrilled about it all, getting amazing results like we've never seen, honestly, to be honest with you. No one's more amazed at all of this stuff than I am. But I do urge you, those of you who are seriously interested in trading, think about doing a Daniel Code tutorial and learning to trade price. It's really swamping everything else that I've ever seen. Okay, so this chart was to show you that trading price is still important. You'll get most of the major turns with it. Problem with trading price, it doesn't fill in what happens in between the major turns so well, whereas trading time, it fills in everything. Not all the signals are on this chart. I just want to give you the idea what it's all about. This is moving on to the US dollar index. Lots of, just bear with me for the moment. I've got something from, I got an email from Hank here, which I'll deal with. And Chris isn't with us. He's a tutorial guy. He's traveling. Kind enough to send me an email saying he couldn't be here today. That's okay. Hank will certainly deal with your question before we finish today. Moving on to the US dollar index, this is a question a couple of you have talked about. This is very, very interesting, particularly to you Americans, because the real way to look at all currency, the important point is what's called the cross rates, where the cross rates, how they rank relative to other currencies. The US dollar index measures the US dollar against a basket of currencies, and it's quite a wide basket. It gives you a very, very good idea. We've looked at this market continually. The point now to look at is that this market is down 50% from its high, its recent high up here. Let me bring up this chart so I can give you the exact dates. Here we are. So this is the, scrunch this up a bit so I'm looking at the same chart. So we're talking about the January 2017 high, that big high you can see towards the right-hand side of the screen. From that high down to the swing low, which is, let me find, it's this one here. I'll find my highlighter again so you can follow this a bit better. Okay, so it's this high here down to this low. That's a retracement, folks, of 50%. Pretty normal retracement in commodity markets, savage retracement in currencies. And from that same high, this is the old high, down to this 2007 low, that's a 44.5% retracement at today's close. And what that means is all of your American assets are worth 44.5% less than they were at the top of the cycle in 2016. Now, I guess if you're never going to leave America, it probably doesn't matter, but these are violent currency swings. This has been totally engineered, so much as these things can be engineered, and no doubt with the US currency, the US Treasury has a great deal of to say about what happens. Trump was saying well before he was elected that the US dollar was far too high, too strong. He wanted a weaker dollar. So Steve Mnuchin said the same thing. And today Trump was in Davos and he came out and said, well, we don't want a weak currency. We want a strong currency, which is pretty much a complete contradiction of what US Treasury has been thinking for the last year and a half. At any rate, that's caused a bit of violence in the market today. But the point I was trying to make to you, if you looked at those earlier charts I've shown you, this market was well and truly set for a turn at some stage. Again, these signals have no reference to quantum. We don't know if we're going to get a big rally in the US dollar or we're just going to get a counter trend of a few days. But it's interesting to just see how much those US dollar assets have depreciated. And is it too simplistic to say, take a look at your 401ks or your investment portfolio, take off 44%. Will show you what your assets worth in real dollar or adjusted US dollar index. Pretty scary stuff, I'd have thought. Most people don't. Most people don't think about that. So maybe that's what does Al Gore call it? An inconvenient truth. Anyway, that's certainly a reality. Okay, let's move on. Look more at this now. We seem to have jumped a few. No, we haven't jumped a few. We've gone straight on to trends. Okay. So we've seen why turns happen. Turns happen when time and price are squared. Some turns can happen where without them being squared. It's not that they're not squared; they always are. It's just that we don't see every possible combination. If you look at the price, for example, to give you a simple example, we can take price from daily bars, weekly bars, monthly bars, 6-day charts, all sorts of different time periods, and price will sometimes morph. Most of the time it works off daily highs and lows, but it can sometimes morph to a faster time frame. In other words, there are valid DC numbers coming off 60-minute charts, 240-minute charts, etc. You can't put them all on a chart, excuse me, because if you do, it becomes a nightmare. Too much information, and you see too many of them. That's also a bit of a problem when we have these really, really long trends as we've had in the US dollar index, because the various market matrices create new signals. You finish up with too many numbers. And that's just a function of what happens in really long trends. But trends I've been talking to you about in the last few webinars, I've talked to you about overbalance of time, overbalance of price. We have much more sophisticated ways than that of measuring trends. But knowing trends for your trading is vital, and knowing before others is the essential edge. And that's because trends control everything we do. If we think we're with the trend, we have an exit protocol. If we think we're against the trend, we have a different exit protocol. If we're with the trend, we'll have one form of position sizing. If we think we're against the trend, we'll have a different form of position sizing. Now, that applies also to our stop loss protocols. If we think we're with the trend, we have protocols for our stop loss. If we think we're against the trend, we use different protocols. Many times, what we think the trend is at the time we place our signal, or place our orders, I should say, we think we're trading a counter trend, and we use just our stops and position sizing accordingly. And then we find at the end of the day, wow, we weren't trading a counter trend. The finished completed daily bar shows us that the trend has actually changed. So that ability to know the trend is absolutely vital to our trading, because it determines our sizing, our position, our stop loss, and we need to know that before others do. That's an absolutely vital part of trading. Okay, so here we are. This is more about Mr. Nuchin. I got this stuff from today's reports. Interesting what actually happens when you get a weak dollar. When you look at it from the point of view of the manufacturer, it's great because it makes your exports cheaper. And that's really been the big push that Trump and his team have been working for. Just boost the US economy, boost the market. A really weak US dollar is great for US manufacturers in that they're selling their goods are effectively cheaper in real dollar terms. As opposed to that, you've got the people who have to buy or hold assets overseas. And a weak dollar is in many ways a hidden tax on people who hold overseas assets. And that's what it does. It reduces the currency holder's buying power in the rest of the world. It devalues the debt denomination. This is the biggest thing in the weakening currency. So, if you are issuing debt at a nominal 100 and you get 20 points of devaluation over time, you're buying that back out or you're retiring it at 78 cents in the dollar. And this long-term inflation, if we look at really long-term charts, many, many years of decades, this ability, this is what compounding is all about. And the reverse of compounding is issuing in a currency that will devalue and closing out your liabilities when that currency is weaker. It devalues the debt, which, as he says here, hurts foreign holders of that debt. It supports prices of assets denominated in the currency because the weakness in the exchange rate from the issuing country makes those assets appear worth much more than they are. Just have a look where US stock markets are, all denominated in US dollars. Think about where those markets really are if you take 44% off them. It's actually pretty scary, but it's real. It doesn't have to be real for you. If you stay in America all your life and only own assets in America, you will barely notice this. But over time, weak currencies raise inflation rates and stimulate domestic activity, which is really what the Fed's been trying to do. Interestingly enough, strong currencies are associated with presidencies like Reagan's. Really weak US dollar currency periods are associated with presidencies like Jimmy Carter. So there's certainly a message there. So I'd like you to think more about that. It's a very important part of your wealth portfolio and allocation. So let's have a look. We're on the US dollar now. What causes turns? This is a US dollar index, DX, and you can see here what's happened. Here's this. This is actually the March contract, which is the new front month. Now the front month. This doesn't quite look right. What am I on here? I wiped it all out. That was clever of me, wasn't it? 88,270. Here we are, 88,270. That's what happens when you've got too many markets and too many computers. We had a Daniel Code blue line today at 88,270 on members' charts. Have a look at these other blue lines here. We had one earlier on, 95.80. That was about, find the date for you. 95.80, there's that little rally up into there. I'll just bring a bit more data in here, folks, so I can see what I'm looking at. This is DX 2018-03. This looks really, really strange. To me, there's the rollover high. This is the high. Okay, we're with it now, I think. Anyway, it's sometime in February. You can see that high. It came down. The first time cycle, the 44, the red line, red cycle gave us nothing. In fact, it was one bar before a minor turn. It did give us a turn. Gave us about a 7 or 8 day rally. I'll just put the highlighter on here to show you where we're at. Okay, that's here. That's this 44 here. Remember, I've told you all these time cycles are valid plus or minus one period. So this was the low came, minor low came the day after its 44 cycle. 1, 2, 3, 4, 5 days rally. Down it went again. Have a look at this here, 95.80. Here's this big bar down, DX. I'll just find this again for you. Life would be much simpler if I could put all these on one chart, but that's not going to happen. Let's have a look. Here we are. Then we had this rally up. 2018-03. Down we are. Look at that low there. 95.80 and stopped it like it was shot. One more bar down, it ran down to the 90.5, did a big key reversal bar. See how strong these numbers are? And then led to a 3-day consolidation before it resumed the trend and down it came. Now today, here's this bar right here today, we had, let's have a look what we had. We had here a blue line at the low, 88,270. This market's been in a downtrend, very, very strong downtrend for a long time. Was roaring down this morning, hit that number like it was hit by a train, reversed and started roaring up. What happened there exactly? Well, we had price. We had 88,270, the Daniel Code blue line number, and we had time. We had a 62 cycle that expired today. You can see that on the chart. What does it mean? Well, we haven't got a turn yet because it hasn't taken out the high, but it almost certainly will. But what we can say is at that low there, we had time and price. We had time and price squared, which means we had time at a known Daniel Code ratio, and we had price at a known Daniel Code price ratio. So that's what happened today. It was pretty exciting stuff. It might be more exciting. We'll see what happens. Okay, now, here we are. What I put on here for you, I've shown you the same chart, but I've taken the opportunity to put on the time cycles, the buy and sell cycles. And you can see that every turn has come at a time cycle. Time is more important than price. That may not be strictly true, but we can see time cycles much more clearly than we can see all of the visible price cycles. In other words, if I was to put every price cycle on this chart, these Daniel code numbers theoretically go from 0 to infinity, and they theoretically work on everything from a one-tick chart to a monthly chart and beyond. So if I put on every number, this would just be a sea of blue. You wouldn't be able to see the chart. There'd be so many price levels, and that becomes totally counterproductive. The good thing about price is that markets use the same 5 sequences all the time. Although there is an infinite number of price levels, markets use the same 5 sequences all the time, which means that when we get around to doing our chi-squared tests, our multiple regression tests, to find out which are the high probability numbers, it's fairly simple, because once we've got the computer program set up, we're still testing for the same 5 patterns. And make that more complex, you'll have the same 5 patterns on an hourly chart. They're different for a 240-minute chart, they're different for a daily chart, they're different for a weekly chart, and so forth and so on. But as you see from the numbers we put up on the Daniel Code website, it's been a very, very long time, and I'm going to say well over 6 months since we've had a market that's turned anywhere except at a Daniel Code number. And when they turn somewhere that's not on your members' charts, they've actually turned the Daniel Code number, but it's a different sequence. And on those rare occasions when it happens, I'll actually put up the sequence and put on the members chart, turned at a different time sequence that was not on your chart. But, you know, it happens a couple of times a year, and we're doing price and time targets for, 15 futures and 15 Forex. So a variance of twice a year out of potential, I don't know, it's potentially you've got 30 possible signals every day, and there's 225 trading days in a year, so we're saying twice out of about 6,750 probables. It's almost infinitesimal. But look at these time signals, it's really beautiful. Okay, let's move on. Now, if you want to be a super trader, email me, jneedham@thedanielcode.com, with your phone number and country and location, so I can work out when you're likely to be around and awake, and I'll give you a call and talk about your trading. And if you're interested in doing a Daniel Code tutorial, I'm more than happy to talk to you about your trading and let you know what the probabilities are there. And we're doing them. We're running 2018 right now. Some of these guys I think are probably going to start next week. Mick, I think. The other one was going to start fairly soon. He's building up in Vale, very nice part of the world. Bernard's with us. Bernard, my friend, nice to see you with us. Gosh, it's been a long time since you've been here. That's great. Great to have you, Bernard. I hope you haven't been hurt too bad with all the cyclones that have been going past, hurricanes going past your part of the world. Folks, if you haven't already had a free trial of the Daniel Code, you're very welcome. Just go to the Daniel Code website, www.thedanielcode.com. Click on the banner, and Terry will be happy to set you up with a free trial, 31-day free trial of everything at the Daniel Code, including the 4th and 5th seal, which Frank DB does for us so meticulously. And we can also arrange a free trial with our partners Genesis of their software and charts if you haven't had that already. Let me see where we're at. Here we are, folks. This is our compliance statement, which I'd like you to read. But when you look at it, you're going to think, crikey, I've had one too many whiskies, because it's all got a bit blurred. And I've got the same problem as the FBI. You know what they did? They issued new phones to Mr. Strzelecki and his lady friend, and shortly thereafter, those phones stopped connecting to the FBI database, new Samsung phones. And apparently it wasn't only them, it was a great number of people in the FBI. Now, if you can believe that a major technical upgrade of something as important to the FBI as cell phones, which are supposed to log on to the website so that all of those texts and data can be captured, as they're required to by law. If you can believe that a major upgrade for an institution as huge as a part of the Justice Department was done, and the people making the change didn't bother to check whether the phones were actually connecting. If you believe that, come on down to Sydney. I've got a very nice big bridge down here I can sell you very, very cheap. And I'm afraid I've hit the same problem they've hit, that I've got conflicting data applications. This is PowerPoint in Windows 2010. And because I hate change, I've always used the old PowerPoints as precedents under the Windows 98. And Windows 10 doesn't like it. It's made it all blurred. So I'll try and get Terry to sort that out before the next tutorial. But it is a real point to bear in mind that trading is risky. Losses are very common, particularly to people who don't know how to trade. If you haven't done a Daniel Code tutorial, you're at risk, and those risks are real. I do beg you to take it seriously. Don't trade with real money until you can demonstrate to yourself that you know what you're doing. Okay, folks, that's about all I've got for you today. Thank you for being with us. Hank saying you've got a question there, and I'll send you a email response to that, mate. That's great. Well, any Happy New Year, folks. No questions today. That's unusual. No questions. That means we're finished for the day, and we're actually on time for about the first time I can remember. Hey, Bob's joined us. A lot of people joined us today, came in late. Aussie dollar, William. Well, look, it's totally and hopelessly overvalued, but same thing. Let's see what we've got here for you. Here's the Aussie dollar. Here's the Aussie dollar. Let's see if we've got it on the 6-day chart. It'll give us more. $12 would be even better. Okay, look at this. Here we are. Bring this up to date for you. You've all seen these charts many times before. 80.64, this is the closing high here. Remember, target recognition on the bar high low or the close. If I convert this to a close only chart, you'll see that's where this close stopped, this little rally up here, 80.64. Folks, to me, I think, I don't know why I'm saying this. You look where this market's been up here. This is 108. The Australian dollar worth 108. It's worth sixpence, honestly. I mean, the inflation in this country is just absolutely extraordinary, and how little your money buys, how expensive everything is just a total and utter joke. I am not an admirer of the Aussie dollar, and the reason for that is that it doesn't trade as its fundamentals suggest. Australia is a net importer of capital. We are always a very, very substantial international borrower, and that's not reflected in this price. This market should be in the 60s, Bill, and this rally, as you can see, since October 2015 has been very sideways and choppy. Doesn't speak of being impulsive at all, just looks to be corrective, means we should have another big leg down. And let's see where we will go to. If you believe in, let's have this is a joke, folks. Just remember, I said it, this is a joke. If you believe in Elliott wave, which in my opinion is one of the great viruses of our time, that wave 3 should roughly equate to wave 1, or is that A equals C? I don't know. I studied Elliott wave. I couldn't get it. Most of the students that come to me, the biggest disasters they've ever had in their life involve Elliott wave. Not to be rude to Bob, Rob Frector, he's a great bloke, and he believes in it. Nonetheless, If the next wave down is to equal wave 1, it would be somewhere below 64 cents. It should really take out the 2008 lows. This country's in a shocking state. The borrowing's out of control. S&P came out this morning, William, and said, yeah, we'll confirm Australia's AAA rating. I don't know why. Absolutely beyond me how anyone could even think that. We're not even balancing the budget on current expenditure. In other words, we're not just borrowing to service debt, we're borrowing to pay current expenditure. But, that's what happens in a socialist country, and we're becoming more and more socialist every day, which is a great shame. But there we are, ruled by the majority. Okay, Malvino, glad you enjoyed it. Bill, you've got the answer to that. Hank, Happy New Year to all of you. Thanks for being with us, folks. Do shoot me an email, jneedham@thedanielcode.com, jneedham@thedanielcode.com. If you forget that, you can just go to the website. And let's see what we got here. Here we are, Daniel Code Online. And just click on Contacts, which must be in here somewhere. Here it is, look, right in front of me, Contacts. Here we are. jneedham@thedanielcode.com. Jerry's address and phone number's up there as well. So it's Terry, who runs this the website and most of the details for us. jneedham@thedanielcode.com. If you'd like me to comment or look at any specific markets next webinar, I'd be happy to. So thanks for being with us, folks. Enjoy your weekend. It's Friday afternoon down under, the sun's shining, which means it's time for Bloody Marys and a quick swim in the pool. Thanks for being with me today. Bye-bye.